It's a pleasure to be joined today by one of the best investors of all time. He doesn't like to hear that, but he is. Mario Gabelli. Nobody is more New York than he is. Born in the Bronx, educated at Fordham University. Then he took a trip over to Morningside Heights, followed in the footsteps of just a few great fund managers coming out of the Columbia Business School, and then going to work, starting his own firm the year the country turned 200 years old. Mario, thanks for taking some time.
Thank you for framing it that way. Always a privilege to talk about stocks.
You've been doing this for longer than the playing careers combined of Joe DiMaggio and Derek Jeter. So you've had some plate appearances. You're on base most of the time, and you've hit a lot of home runs. Tell me, when did your investing career begin, and how did you get into the business?
That's a great question, John, but don't ignore the fact that I get on base also by sticking my head in front of the pitch.
You get on base that way, too.
What happened was the following. Somehow, when I was about 11 or 12 years old, I was getting a ride to caddy at Winged Foot. They did not have a focus on age limits. So if you could carry a single bag, you did that. About when I got to be a little older, I went to another country club in Westchester because I could take a bus from the Bronx and another bus, and I could sometimes, what you could do in the 50s was hitchhike. And went to a club called Sunningdale Country Club. And Sunningdale had a pro by the name of Whitey Boyd. And Whitey, I caddied for his two sons, one of whom was a famous rock singer and had a band, and it still is. And the other one is a guy by the name of John Voight, who has a career in Hollywood, and the daughter. So, but the point I'm making is that the other caddies would come in from Yonkers, which is a suburb of the area, and would have a bus that would take them back to their home, let's say at 4:30. So I would hang around, and the specialist on the floor of the New York would come up and play 9 holes of golf. And they would talk shop. And so as a result of that, I said, whoa. So I started buying stocks probably at an age the broker never asked me for my age, at around 14. So I'd buy Beach Aircraft, Philadelphia and Reading, IT&T, and Pepsi-Cola. As a result of that, there was no online way to get stock prices. So I'd go over to the local news store when I get home at about 6:30, and they had a newspaper called the Journal American that was a late afternoon publication. And I would read, and then I subscribed to Fortune and Business Week, so they would come in, and that was me. And then finally, when I was in high school, I started reading the Wall Street Journal every day.
That's a pretty good preparation. And then you went to Fordham, right? Later on, sometime in the 50s, early 60s?
Yeah, I got scholarships in high school, which was a Jesuit school called Fordham Prep. So I was able to take what was known for those old New Yorkers, the Third Avenue L, that used to go from the Bronx to Chinatown, and then it went from the Bronx to 149. So I was get on the L, and basically, got scholarships to Fordham that could not be taken out of state. Otherwise, I was accepted at Wharton, and but it is what it is. So that's the background, and I had some great professors, some of whom I remember in accounting and finance. Finance guy, Eamon Kelly, was going after his PhD at Columbia. He wound up at Tulane as the president of that school. So we do teach you money in banking. So I was very fortunate. And in addition to that, I was able to do a lot of gigs.
Did you go right to Columbia after Fordham, or did you work?
Yeah, they had a different rule back about that time period. So as a result of that, you didn't have to wait. There were kind of 2 years of that we now do. I've been on the board at Columbia Business School now since the mid-'60s, so mid-'80s. So that's 35 years. And just they like people that work for a couple of years. Yeah. At that time, they didn't care. Okay, so I was in a class with guys like Art Sandberg, Lee Cooperman, and so on. And that was the plus.
What a fraternity. That would be,
agreed. But the real magnet of all of us was that we took a class. The reason we got together was that there was a subway strike in New York. And as a result of that, I would drive over to Riverdale in the West Bronx. They'd get in a car and they trusted my driving. And we would go down in Columbia, and then I moved there So we would always see each other and still in close touch, except for Art, who passed on. And we had a professor by the name of Roger Murray. Roger succeeded Graham and Dodd in doing value investing. And as a result of that, we all took him in the same class. And as a sidebar, John, there was only one payphone in the school. And we'd rush out, and Lee would always get there first, but we decided to share brokers.
You had to in those days. It was so expensive to trade, wasn't it? I mean, 300 bucks?
The pre-1975 commissions generally were fixed, particularly for retail. Institutions started getting breaks, and then after the May 1st, 1975, the commissions became unbundled. And I was at a firm called William D. Witter, and their business model was based on 75 cents a share, and when it dropped to 25, they changed some of the, that's why they were merged, and a lot of the research firms merged into other firms. Basically, it's now a dime, and now it's probably 3 cents. So,
yeah, I mean, retail investors, it doesn't cost anything, at least up front. But
they don't know it because of the paper play.
The order flow. All right, so there's you and Lee Cooperman sharing a payphone to get brokerage orders in at Columbia. What were you guys in the same classes? I mean, did you study the same stuff, the same professors?
Well, Lee had already gone to another university before he went to Columbia to become a dentist or something like that. And
that's right.
So he wanted to finish very quickly. So he went through what they call 4 straight semesters. So I graduated in May or June, and he graduated in January. So, but Art and I were in the same classes, more or less, for 3 or 4 years. So the 2 years, I mean.
So you come out of this institution that's renowned for value investing, the best practitioners, probably the first people to ever figure out to coin the term value investing, Graham and Dodd. So do you think of yourself as a value investor, or, what is your investing style? You're a bottoms up fundamental guy, and
stop. Well, I had, I think, tuitions that I had to pay, loans, and not a lot, but enough. So I got a job on the sell side research. Sell side was very fundamentally important at that time because you focused on an industry. I wanted to focus on an industry. Okay. And so I got a job with a firm called Loeb Rhodes, and Loeb Rhodes then became part of Shearson Lehman, blah, 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 and so on. So I joined on a Monday. On a Friday, an extraordinarily successful investor, Michael Steinhardt, had started a hedge fund. So I picked up his industry. So I was the auto analyst, farm equipment analyst, and conglomerates. And a couple of years later, the analyst that covered broadcasting quit. And because I went to Detroit, Cleveland, Milwaukee, blah, blah, I also wanted to go to LA. And I only found one company in LA called Earl Scheib. It was hard to justify a research trip there. So because I said, I want to follow the broadcasters. And I convinced the director that, CBS was in Midtown on 6th Avenue, and NBC was there, or RCA at the time, and then obviously ABC and so on.
Yeah.
And the broadcasters like Cap Cities with Tom Murphy and Lynn Broadcasting. And I didn't tell them that the real reason was that I figured I'd have to understand content.
Right.
So I then was able to go to LA, and there were only 2 or 3 analysts that covered the movie companies, and the other guy, I know what he looks like, but I can't remember his name. So, on the sell side, there were always a couple of buy side guys, particularly at Cap Research in LA and so on. So that's how I got the background. And when Loeb Rhodes bought Hornblower Weeks, they were going retail, and I wanted to do institutional. So I left and joined William D. Witter. We merged into Drexel. And I walked into Tubby Burnham, and I said, listen, Tubby, you're a great investor like Mr. Loeb, but you're too big. I quit. So I started a sell side, that is, sold my research in January of 1977. And there were only 4 people that started firms at that time in the whole country. I was one, a guy in Chicago, John Keeley, another guy in Dallas, Rusty Rose, and there was a 4th guy whose name will come back to me later. That's it.
Yeah. So there you are. President Carter is just about to get inaugurated. There's political instability around the world. Iran's in revolution. Inflation is raging. Interest rates are going up. But you found a way to make money in small caps, as I understand it.
Well, what happened was the following. I couldn't raise any money. I rented, I was able to get a space 40 wall where Mr. Loeb was very influential with the landlord. And he said, the building's empty. Why are you seeing me to help you? He said, because whatever I rent is going to be either too big or too small. I need a 1-year lease and they want 5. So he helped me get a 1-year lease. And you couldn't, the telephone companies were on strike. So I'm on the corner of Wall and William in a snowstorm making phone calls on a pay phone. You know, you got to go through this stuff. Okay. Bottom line, the question was, how do I convince people to buy stocks? And it was headlines were the death of equities, you know, and multiples were 3 or 4 times. Interest rates were rising, as you pointed out. So I came up with the idea that if I had a public company and I could take it private, what would someone pay and who would buy it? And it had to be a wealthy family. So that became what we called and is known as the private market value. And because my clients were not thinking 10 years, but on the other side, they were primarily taxable accounts, they wanted to make long-term capital gain. So we came up with the idea of a catalyst that would surface the values over 2 years. And that's how we started following companies. Now, I was very, you know, there was a lot of great companies at the time. And we followed companies that, $20 million was a large, not a small cap stock, you know. You got to think back. Right. So we came up with ideas about companies that I then published that were taken over. So there were companies that were taken over because the private market value, the catalyst, and we used to publish something called Rest in Peace. We spent years of work on some of these companies like Burns Detective Agency or something like that, and it would be taken over. We just had that just happen recently on a company called Griffin Industrial Park. INDT was just taken over yesterday at 67. It goes back to the times when we're writing an article for Cigar Aficionado, and we'd cover all the cigar companies. And this company sold cigar leaf, but they also had the rights to import. So there was a lot we were doing in small and mid cap. And then a guy from Forbes found me. Okay. And he saw that I was recommending a couple. I recommended 3 or 4 small caps, micro caps, Rex Norico, the Outlet Company, or something like that. It had to be somewhere in 1960, 78, 9. And he would write, and he, published a story about what I was doing in the small cap world.
Yeah, that's where you made your bones. I mean, a lot of it in the beginning. You went into natural resources. You have a gold fund.
No. Subsequently, somewhere around 1989, when I quit Loeb Rhodes and joined William D. Witter, then people would say, why don't you join us? Bear Stearns wanted me, blah, blah. And a friend of mine ran a firm called Pomboy Cantor Winkler. And Pomboy became, in the early 80s, a gold bug. And while I didn't join him, I analyzed what he was doing. And obviously in the late 70s and early 1980, we had the Silver Hunt challenge. And then what happened is that a firm I think it was New Jersey, okay, could have been Livingston. And they were basically going out of business, and they were merging into another company. And one of the analysts that was there was a guy by the name of Caesar Bryant. Caesar's a Brit. So in 1980, he took his wig and his robe because he was a barrister, sold it, became what they call the sell-side analyst following the mining industry, and he covered gold. And then, there were 3 individuals. John at Tocqueville, another guy I know what he looks like, and Caesar Bryant. So Caesar joined me. So that's how 30 years later, we still have a gold team. And he's one of the better long only,
sure,
bottoms up analysts that started with his mining background in London at Montague and covers all of that. I think Caesar was born in Mauritius, somewhere one of these British islands. So that's how we got that. We got into the convertible business in the 80s, and somewhere recently we wound up merging with a guy Tom Dinsmore's family, Ron Dinsmore, started the Convert somewhere in 1971, and obviously dealing with people like Tracy Maitland at Advent. So that's how we have different products. And then I was sitting on Barron's forever, and Peter Lynch was next to me, and he kind of gives me the elbow and he says, Mario, I got a product that I can help individuals. Their CEOs have an administrative assistant, and they have a couple of $1,000s to invest. We have mutual funds, open ends, and I've started something called Magellan. Oh, thank you, Peter. I said, how much do you have in AUMs? He says, I got $4 billion. I got A year later, I said, Peter, how you doing? He says, I got $16 billion. So we said, we're starting an open-end fund. And we started in the value world called Gabelli Asset. It's been around for 30, 40 years. And the other one, we started a growth fund. And so that was why we wanted to balance it off. And that's how we have the growth team. And Howard Ward joined us somewhere in the early 90s. And he's still with us.
So, and then you have GAMCO, which is the hedge fund, right? GAMCO Asset Management.
Oh, I felt a moral obligation to. What happened is on Wall Street, you used to buy or sell at book. A couple of companies went public, selling at big prices relative to book. Like I think Merrill Lynch went public. Goldman had not gone public yet, or something. I forget. Maybe Neuberger Berman was going public, whatever. So we went public in 1999, February, through Merrill Lynch and Smith Barney. We have the firm's GAMCO is a generic name for a publicly traded stock that owned the mutual funds called Gabelli Funds.
Right.
But we also created something called GAMCO, which was where our separate long-only accounts. And then prior to that, that was 19 blah, somewhere in the early 90s. Oh, no, in the early 80s, we started hedge funds. We still have a long-only hedge fund. And then we started merger arbitrage, M&A, which we do, which we like, because I go back to my days at Loeb Rose, where somebody would ask me in the ARB desk, because I do the research, what do you think of this deal? And I got to know him. His name was Charlie Blatt.
So your style that unites your investing strategies throughout your universe that you manage money, how would you describe it? Value, growth at a reasonable price?
No, that's
a label.
But let's go back. First, I think it is simple. You take because when I was at Fordham, I was an accounting major, finance and global taxes and whatever in Columbia Graduate School. You basically take an annual report and you drill into it. Okay. So you look at that, but more importantly, because you follow an industry, you go in and read all the trade magazines, you go to all the conferences, John, you go see 5, 6 companies. So if I'm visiting company X that's making brake pads, I can ask them, what's going on in the industry. But then I go to the second company, I ask them what's going on about company A, And so you get a feedback mechanism. Mm-hmm. And as a result of that, for example, one time there was a company called Safety Clean, and they would sell products. And Snap-on Tools, they then created Safety Clean. So I'm saying to myself, listen, I go to a local gas station guy and I say, what do you buy? Okay, so I convinced the company to allow me to ride on the truck and watched how the guy actually functioned and how he made money. So we go bottoms up in an industry in which we cover a lot. If you're what they call a special situations analyst or a generalist, you don't have as much time to focus. So the notion of intense focus on selected industries. And so, the area of automotive, we still have our 46th annual auto parts conference coming up. And you go from individuals from Intel that show up to those that sell used cars, to those that sell batteries, to sell EVs. And so you transition that over an extended period. But the bigger change, John, for me, was that when I set up an auto analyst. I was president of the auto analyst in New York. We go to China and Japan in the early 80s. In Japan a little earlier, but not to invest, just to understand what's going on. Mm-hmm. When the Berlin Wall came down in November of 1989 and Tiananmen Square, we said, we got to go global. So that's the other part of the dynamics that have unfolded. And that's it. Our analysts do look at industries in which we have significant accumulated and compounded knowledge, and we still make mistakes.
Yeah, but it's like baseball. If you're, as long as you make fewer mistakes than you do great plays, you're gonna do fine.
Well, it's like Ted Williams. He batted .400, but it means he made out 3 out of 5 times.
Exactly.
Yeah, I know.
No, you're doing well with that. What looking back on your investing career, going back to the 60s, 70s, is there a single big triumph that you like to think about and say, wow, that was really a great one?
Well, I was very fortunate to cover the broadcasting industry. And because I did broadcasting, I really was able to understand the impact of inflation on revenues, gross margin, and cash flow. And secondly, I was very fortunate to have Tom Murphy and Dan Burke in Midtown Manhattan running a company called Cap Cities. So I watched what they did in terms of use of cash flow going into and then buying from clients of mine, obviously not big owners, but ABC, and then merging that into Disney. So you look at it, and Tom just passed on within the last year or so. And so that following an individual like that with regards to understanding where they derive the demand, understanding all the rules of regulation, understanding how they did tax structuring and deal structuring was extraordinarily helpful. And but the other part that you should be aware of is that I followed business services. And in Manhattan was a company called Pinkertons. In Briarcliff, there was a company called Burns Detective Agency. In Florida, which is why I'd go to Miami, was Wackenhut. And when I went to see Wackenhut, I'd have to go see Wometco. But staying with that, a big investor in Pinkertons, which was down in the Wall Street area, was Warren Buffett. Mm-hmm. So I started reading about what's Warren doing? Why is he so tax sensitive? And yet he talks that, he downplays this notion of taxes.
Don't let the investment tail wag the dog. Yeah.
Yeah, the fact is that he was very aware of how revolutions take place on a global basis, how he did work, how he was at Columbia with Graham and Dodd and had Graham as a professor and was a partner of Jerry Newman, I think it was, at Philadelphia. And Jerry ran Philadelphia and Reading, which was one of my early stocks. So I kept following that, the Reading company. So that's how I got to really focus on Buffett. Okay, we knew about him, but you never watched the mechanics of it. So when I started one of my funds, I immediately bought Berkshire, and that was at $3,000 a share.
Well, I think it's gone up a little since then. Yeah.
I
guess that's you can call that a home run too. Burying the lead. Well, is there anything that stands out? Did you get burned ever early in your career or later in your career?
No, what happens is the following. So I'd go to LA to visit with Earl Scheib.
The place where you got your car painted?
No, 19 any car, any color for 1995. And I did have an old car that I did bring, and they did the windshields and they painted too much of the car. But so I would go out there, but he'd say, Mario, of course I'll see you. However, you have to be here at 7:30. And I said, fine, because that's, I'm up at 4:30 I'm at work already in New York. But I then finally asked him why. He says, well, because I have horses running at Santa Anita and I want to get to the racetrack. But bottom line, they had a great business. They refused to do a few things like morph into repair and maintenance. I held the stock for probably 30 years. So it's the loss of return on capital. And then we had other companies that have gone bust over the years, where you enter into a cycle. And that taught a lesson about not buying certain companies that were highly levered going into the cycle that went into la-la land and had negative cash flow and balance sheets that were highly levered. And when the interest rates started going up, those are the ones that have had some challenges, like Carvana.
I've noticed
Peloton,
that.
The stories.
So some of the biggest picks that some of the stocks that you're really going for now, one characteristic would be low debt levels because we are in
there's two types. Okay. Right now, ideal world is a good business with good management at a low value.
Yep.
Yesterday, we have one with a good business, great management, but a high valuation. The guy has done a great job running a Badger Meter, but it's now 25 times earnings. There are times of the cycle, John, and I'm not saying we're there yet, but where you buy bad, an okay business with uninspiring management, but you're buying at a distressed price. Because what's going to happen to that company is somebody's even if they have no debt, somebody's going to buy it to consolidate a sector, and they're going to basically increase EBITDA or operating profits at a substantial rate with limited incremental effort.
Right.
And so I'm not saying we're there yet, but recently we were because of our work with Herc Equipment Rentals, work with Terex. And somebody reminded me yesterday that I had written a report on this company. It was the report on a company called Manitowoc was cranes, cubes, because they had ice cream machines, and cash. So we started buying the stock at 10, 8. All of a sudden they have a okay, but because of the Inflation Reduction Act and the IIJA, they're going to get a lot of money in infrastructure improvement, and the stock has gone to $18 from $8. Uninspiring company. One that is going to report shortly that is equally uninspiring is a company called Hyster. HY, located in Cleveland area. 16 million shares. The stock is 480 million. Some debt, obviously. But they sell equipment in China. So if I am trying to automate a warehouse and you have reshoring in the United States, you're going to buy their equipment. They needed to get into more electrics faster. There's another company, but that's privately owned in that area that's doing a great job. And I talk to the CEO every so often because he's involved in some organization I'm involved in. But they also have been cash burn developing hydrogen. And they have earnings will be kind of lackluster in the quarter. But can I make a triple or a quadruple in the next 3 or 4 years? Yeah. I got a company in Milwaukee. 4 million shares, stock's 20, decent balance sheet, no debt, no pension. They have operations in China, in Europe, and Mexico. And what they do is they make the tailgate on the Ford Lightning. So they're on the EVs, but they also do something else. For example, if you have a car, I'm looking for my key for my car. Anyway, you got an FOB, a fob?
Yeah, sure. Those.
Yeah. They have the DNA on about 80% of the 290 million cars in the United States, and they are involved with a German company that can help you around the world. So what you need is the cycle's going to improve. They're going to earn, let's say, $6 to $8 in this cycle. Then how do you get a multiple? And you get a multiple because they can take that FOB and they can offer it to you and me for $2 a month. If you ever lose it, the next day we'll get it back to you. If you go try to get it now from a dealer, you got to schlep down to the dealer. You got to pay $300 or $400. So they have that capability. They're not listening. So the management is okay. They were spun off from Briggs and Stratton. So those are the kinds of things we look at. Now, why do we even look at this? Is because we look at OE companies. So when you go to Milwaukee, you see Badger Meter, you see Briggs and Stratton, you see this company, you see Rockwell, you see. So we go in and we see 4 or 5 companies. So if you fly to Milwaukee, you don't see one company and come back. My most recent trip, we went up to Racine, Wisconsin, drove up to that part of the world and saw like 6 companies in a day. We drive fast.
Yeah, I guess so. You got Manitowoc up there. You got Harley Davidson. There's like you said, Case, I think it was, or AGCO.
J.I. Case at one time was in Racine, Wisconsin. The 2 companies in Racine that we own now are Modine, and we own another one called Twin Disc. And Modine has a new management. Stock's gone from 10 to 25. He's doing an interesting opportunity in what they call data centers because they're providing infrastructure support for data centers, and that's doing well. Secondly, they're managing the cost structure better. So there's a lot of improvements. And our annual report, John, just as background, we public company, so I write one. Basically, about the 1980s, mid-80s, the Japanese were doing extraordinarily well. when you were still in school in 1986, Cleveland was supposed to be a depressed area, blah, blah. The river was on fire from the...
Yeah.
I know. There are a lot of good companies. There are a lot of good management. So we started with a Hall of Fame. So every year we induct 3 to 4 individuals that have been companies that we follow that, the values have surfaced, okay? For example, this year we're taking a guy from Swedish Match, long story, and he's coming into it because Philip Morris bought them and our clients owned a ton of it. We got a guy out of Nashville by the name of Colin Reed, who runs the Ryman.
And Torium Plate, the real estate trust, Yeah,
that's got the REIT. They own the Ryman, and they own the Gaylord, and they got one in Denver that they opened within a year. They got one in Washington, D.C., which is doing okay, but not great. They got one in Texas, which is booming, and so on. That's part of the business. They converted that to a REIT format, and then the other businesses, they're in the entertainment business. Somehow they realized the Loretta Lynn started off in Nashville, and it's country and western, and they've got a whole bunch of infrastructure support for that. And you're talking about 60 million shares of a $90 stock, 5.4 billion, a little more debt than I like, but the cash flow is fine.
Is there anything right now that you think is very important for investors to know in the current economic? I could talk to you for hours, but
yeah, no, I'll make it quick. Shorten it. Basically, from a new investor, if you're 20 years old, basically, and you grew up on Fortnite, you like to have short-term gains. Think about long-term. I'm sending you a grid that I use when I give college talks about how to become a millionaire, and that is to have one less. And I'm not knocking Starbucks. I just use it as an example, and take that money in and invest it. So one less per day, and you're putting $35 in a week, and you grow it at 4, 6, 8, 10% over the next 40 years. Where are you going to be? And if you really want to help yourself, one less beer, one less Truly, one less White Claw, So that grid is important. That is the notion of compounding of value over an extended period of time. And if you are lucky enough to have a grandparent or a parent that can start at 529, the government is going to allow you to take a portion of that and put it into a Roth IRA. So there's a lot of dots you can put together. And other than that, you got to ask the question.
Appreciate you taking the time. Thanks, Mario.
Thank you. Take care.
Have a great day.